I think this question around mutual funds or insurance has been asked by many. There are lots of investment pundits who have their own opinions. You see a lot of new media and media reporters talking about the benefits of one over the other. I think the question actually is very specific. It depends on who and what the need is. Without assessing the need and who the person who is consuming these products, it's very difficult to make a generalization. For somebody, a mutual fund would be better suited. For somebody, an insurance product would be better suited. For most people, a balance between the two is what is needed. The reason I say this is because mutual funds have a certain specific purpose. They are built as investment tools only. There is no insurance element. There is no longevity element. So tomorrow, if you happen not to exist, but your need happens to exist, let me explain that. You want to send your child to management school, and you're saving up for that. You have 7 years to save, so you decide to put a systematic investment plan through a mutual fund, a SIP as they call it. Now, year 4, something happens to you and your income earning capacity goes away, or touch wood, if death happens, then there is no corpus being built after year 4. So how do you send your child for further studies? That's where an insurance plan comes in handy. The insurance plan have various waiver of premium benefits. They also have income benefit programs. They also have premium continuance benefit programs, and these may sound technical, but in effect what we are saying is that in the event that there is a loss of income for the individual, or loss of ability to earn that income, or the person doesn't exist, the dreams and goals that they've set for their family should continue. Should that be the only investment, therefore? Answer is no. The insurance investment may not give you the scrupulous returns that a mutual fund investment or an equity investment will give, but it will secure the reason for you to put your money in there. It's creating a corpus, it's making sure that you get your money. It does have, therefore, lower return in most cases than market-linked investments. Yes, there are some mutual funds that don't perform well. Yes, there are some unit-linked policies of insurance companies that perform better than mutual funds, but those are timed based on market points. If you take the long run, the objective should be in defining what your goal is, what the interest rate currently is in the market, how do you see your investment grow, and making sure that there are fail-safes. So if you're a person who would be focused on the end goal and have a certain need, you should ideally diversify your portfolio. If you're a person who is willing to take a little bit of risk to get higher return, you should definitely invest in equity directly. Mutual funds are for people who want a little more safety, diversify their risk in different securities through a mutual offering, and the insurance product is probably a notch safer because it makes sure that at least the product is available in the event of the individual not being able to contribute to that fund, or not being there because of not having any income, and therefore it secures you. Having one or the other doesn't necessarily define good financial planning. You should have a balanced portfolio. The question then can arise is, where do you start, right? And that actually is the key aspect which most investors and people who want to save miss out on. They go by recommendations because they heard somebody else has done something. They go by advice from people around them, and actually to ape somebody else's investment or saving is actually the worst starting point, because the investment for you or the need for you may be very different, the investment need, from somebody else's need. And to mirror that exactly by copying their investment could not be the most wise thing that you do. So therefore, how do you decide? You decide based on what your long-term goal is. You decide on how much liquidity you have today. You decide on what instrument allows for you to meet that goal. And then you decide on how much you want to put in instrument A and instrument B. Take the example of any 27-year-old lady who's worked for 3-4 years, is planning to get married or has just gotten married, intends to have a child 3 years in the future, and perhaps is looking to secure a little corpus so that she can create a fund for her child's education. The ideal response would be, let me put some money away, tuck it away in a systematic investment plan in a mutual fund, which is true, it's a good investment. It will give you a forced saving habit because from your salary, you keep putting money away. However, 3 years later, when she has the child, what happens if she has no income earning capacity anymore? Will that systematic investment plan stop at that point? That accumulation that has been done for those 3 years, is that going to be enough to put the child through college education? We don't know. If that investment was diversified with a little bit of insurance and a little bit of direct equity, it perhaps have a slightly larger and more rounded portfolio. To get such advice, and it's not something that you can pick up on your own. You could, but it's good to do a financial planning session. There are enough advisors available to do so. You can connect with them and they will bring to you the ideal solution for you rather than aping the vast majority.